Is the Reflex rally over? That's coming up on 3 Minutes on Markets and Money. This morning, Target reported worse than expected earnings, missing largely on revenue and earnings as they cited higher cost pressures and a build in inventories as two of the problems related to their earnings. That stock's going to open down about 22% this morning. So a very big drop in Target, which has been a fantastic really kind of play here for a while. Even during this entire consolidation process, Target has held up fairly well. This morning, the stock's going to open sharply lower here. So again, that's going to be some pressure on the overall markets. But as they're talking about, rising inventories are now starting to impact them along with rising cost pressures. And as we've talked about in terms of inflation, we have likely seen the peak of inflation, and what we're now starting to see is slower consumptive activity by consumers. These are all pre-recessionary indicators. They're also disinflationary. Rising inventories, less consumption, that's deflation in a bottle right there. And we're going to start to see this potentially pass through. Target emulated what Walmart said yesterday in their earnings. Walmart also down about 11% yesterday as well. So those retail stocks are really the bellwether of the consumer, telling us now that consumption is indeed slowing down. We're starting to see this now as consumers go out to take on more credit card debt, credit card applications on the rise. That means that they're having a tougher time making ends meet out of what they earn and are needing more access to credit just to continue to pay for gas, food, those type of things. Inflation beginning to impact that consumption trend. Consumption, 70% of economic growth. These are all indicators now that are telling us that the economy will slow down over the next few months, and that will ultimately impact earnings for companies over the next quarter to 2 to 3. So what we're seeing now is probably only the beginning of a contraction in corporate earnings and profits, and that's going to weigh on prices for the S&P as we move forward into the rest of this year. So is the recent rally that we had over the last 3-4 days over? Let's take a look at the S&P. Over the last 4 days, we've actually seen this market finally bottom here, turn up a bit, had a nice rally yesterday, and we're looking to finally get some follow through on a rally. We haven't strung 4 positive trading days together in a while, and we've actually got 4 positive green candles here rising. Again, despite the fact that yesterday was a fairly large move in the indexes, it barely registers on the market after this previous decline that we had from the previous March highs. Market still remains in a very defined downtrend. We're starting to move up to the top of that downtrend channel. So again, that's going to provide some current pressure here. Now, markets are slated to open a bit lower this morning. It'll be important that over the course of the trading day that not only do we maintain kind of this support where we were yesterday, but that we don't give up all those gains that we had yesterday and start pushing back down towards recent lows. We don't want to see that. If the market can kind of just open lower and then kind of flatten out and maybe rise into the end of the day, that will be okay. If we can tack on, even though it'd be a negative day, have a positive green candle in terms of just price action during the day. In other words, we close higher than where we open. That will be positive enough to keep this potential rally intact. Again, we're very close to triggering a MACD buy signal from a very oversold level. The stochastics, RSI, and Williams percent R are still all oversold here as well. So again, we're starting to turn up those oversold indicators. That's positive. The MACD very close to turning positive. If we can trigger that into a buy signal, that tends to lead to better rallies in the short term. The last time we did this was back in early March. Very nice rally to the top of the Bollinger Bands before this next decline. But previously, just about every time that we have these buy signals, we get at least intermediate term rallies that make for a decent trading opportunity. And again, that's all we're talking about here, is using this rally to reduce risk into, again, as I said, what we're seeing economically, what we're seeing earnings-wise, does not bode well right now for a continued running bull market in the near term. So we're looking for an opportunity to reduce some risk, raise some cash before some of these other impacts come in later this year. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.